That's a huge thing for investors is they're so focused on maximizing returns. It's not about that. It's about creating a plan that's going to give you optimal returns for that long-term strategy, not maximum, right? Optimal meaning it's a strategy you'll stick to.
Nate. Anything?
Nothing on this one.
Really?
Yeah, I don't know. It's just maybe not my era. I do have my older siblings. So my brother was born in 1980. So like I grew up with some music that is, when I was born 10 years later, but nothing.
You got nothing on this one?
I got nothing. Let's hear your stories behind it.
Well, hang on a second. Okay. How about this one?
Oh,
all right. Well, hang on a second.
I was going to say.
The intro doesn't give it away, but let me just speed it up a little bit. Hang on a second. Ready?
Yeah. See, this chord progression, that gives it away.
Right. So here, we got the Guess Who behind me. All right. So that's my album of the day.
Yeah. And I did mine in the honor of my son. I have an 18-month-old at home, and so Big Bird.
Do you have some Big Bird queued up?
I could sing some, but I don't think we want to hear our ABCs or about our feelings.
We're going to end it with American Woman right there. So,
yeah, that's a much better intro.
What I should have done was broken out some No Sugar Tonight in my coffee. No sugar. Anyway,
yeah.
That's another classic Guess Who song.
Seems like it fits between sips with your sugar and your coffee. Maybe better than our show. I
mention it to Jessica and Emily for sure. So,
but hey, today we're back for another episode of Off the Wall.
We are not here for music commentary.
No, but maybe that'll be the third podcast we start.
All right, yeah,
right. Tune in,
Hey, I love the fact that we're changing the albums up. I will say this to, if there's any listeners out there who have a pile of records and you're like, I don't know what to do with this, I will pay for the shipping to have them sent here so we can have a little bit better of a rotation because, records, they're hard to find.
They are. I know you said you got a big chunk of them and I was looking through them. We're really set up for Christmas time.
Yeah. Oh my God.
We could put a
ton of Christmas vinyl.
All of
Christmas vinyl. But if anybody out there is listening, you've got records you want to get rid of, I want the cover art. I don't even care how bad the actual media is. I just want the cover art for the, keep rotating it around.
Hey, aesthetics matter.
Kind of like market rotation.
Correct, right?
Kind of like dollar cost averaging.
Oh, look at Dave. He's got it going. And
did you see what I did there?
He did the perfect tease for what we're talking about today. I think everyone knows market volatility is inevitable.
Right.
It's going to happen. I think a question that we like to dive into or talk about with clients most of the time is, well, how should you be investing your cash during those times? Because you can do it intentionally, strategically,
right,
and in a way that can add value, but does it? Maybe is a good question. So
I guess we're going to jump into it.
Yeah, we'll go right in. I think just to level set everything right off the bat, just jargon breakdown, you said it, dollar cost averaging.
Right, or DCA.
DCA is what we're going to use it here just so I don't have to use word salad all the time, but dollar cost averaging, DCA strategies. What that really means is over a set interval of time, investing a percentage of your lump sum of cash. Right. So just to use an example, let's say you have $1 million you want to invest in cash. You had a liquidity event, you just sold a business, whatever it is that got that $1 million of cash, how do you invest it?
Right.
And do it in a way that's maybe intentionally strategic. So let's say over 6 months or 4 months, pick a time frame, you're investing equal chunks in each of those monthly periods.
Right.
And I think what most people view it as is a way to gradually get into the market. So instead of putting all your money in from day one, and the market, of course, goes through that volatility and you see all this value, hopefully you invest a little piece here. If the market goes down, you get to invest it at a lower price. That's a good thing.
Yeah.
You're buying below where you were. Now it can go the opposite way. Is if the market goes up and you put it in, now you're buying at a higher price. But over time, all those swings, whether it's going up or down, hopefully you're buying more as the market is, below that first purchase. But it can go up and down, up and down, up and down, and even out over time.
Yeah.
So that's dollar cost averaging, I think, at a very high level. It sounds really great to investors. A lot of people do it naturally in their 401k plans because think about it.
Yeah.
You get paid every 2 weeks, twice a month, and you invest a little piece in the market.
Without even thinking about it.
Without even thinking about it. So when you have $1 million or whatever giant sum of cash ready to invest, how should you invest it? What's a good strategy to get into the market?
Right. So the 401k is actually one of the best examples that we can use for this conversation and frankly, a lot of others, because think about your 401k. You just said it. You don't even know that you're dollar cost averaging. You're just kind of forced to, right? And then what's the thing that actually keeps you doing the dollar cost averaging in your 401k? Well, it's the fact that you're like, I can't have access to the money for the next 20 or 30 years anyway, so I don't even look at it. People say that all the time. I don't even look at my 401k. It's like, okay, now imagine if you take that sort of psychology and apply it to all your other portfolios, right? Okay, so that's sort of how you know that dollar cost averaging and long-term investing and not looking at things and not being reactive behaviorally is supportive of a good investment, overall long-term investment strategy. So think about 401k for a second.
Yeah, and I think just real quickly there, I mean, that's dollar cost averaging is an investing strategy, but I think we're also going to talk about it's an emotional management strategy.
Totally. Which is why the 401k plan, again, is a great example of it, because you can't really, it's not like you're calling up your HR group and the HR department and saying, can you shut off my 401k contributions this month? I'm a little worried about the market. It's on autopilot. It's set it and forget it. You're forced into that behavior adoption.
Yeah.
Whereas some of your other investments, you may not be forced into that behavior adoption. Then all of a sudden your caveman brain starts to take over and you think, hey, fight or flight, I have the ability to foresee the future based on my gut instinct, right?
Yeah.
Which was great if you were trying to save yourself from being eaten by a grizzly bear back in the day, or a dinosaur or whatever ate people back in the day. But not now.
Yeah.
But we still kind of rely on that. So dollar cost averaging, it's actually not the best strategy from a statistics standpoint. So Vanguard did this study. They went back to 1976, and they found out that just lump sum investing beats dollar cost averaging almost 70% of the time, right?
Yep.
Now, so great. Why are we talking about dollar cost averaging? Well, because the stat has this hidden assumption, and this is the part that people don't actually talk about when they talk about these studies, is that it requires the investor to actually stay invested. Okay, that's great if you had a lump sum payout 3 weeks ago and you said, put all of my money to work, and now you hit a rally, or you did the same thing a year ago this time and you hit the rally, or you did the same thing in the October of 2022. Okay, so that you get this huge tailwind, and it makes it a little bit easier to absorb losses or pullbacks in the future. The problem comes when you invest on a Monday and by Friday your portfolio is down 20% and your $1 million is now worth $800,000, and it takes a lot more of a tailwind to dig out of that hole. So the timing of it so you've got to let that lump sum investing work over time. And a lot of times people just, if they lump sum invest and they think they made a mistake, their immediate reaction is, I need to stop the bleeding.
Yeah. And I hate that phrase. Hate that phrase in investing. And I get it. I get where it comes from. Because it is painful. It is painful to see all this money that you have start to go down in value, especially when you just put it in. There's some element there, and I don't know if it's recently had $1 million and now I don't, that makes it more painful. But, you see these declines. I think people, as you are investing for longer periods, you just get more comfortable with it. It's a time game.
Right.
And that helps with emotional management too.
Right. So dollar cost averaging, DCA, it doesn't win on the spreadsheet. It wins in the chair. It wins when you keep your seat and stay invested when things get ugly and you're fighting the urge to start messing with your portfolio, right? So it doesn't win in the spreadsheet, it wins in the chair.
Yes.
Which is why, hey, well, Dave, if 70% of the time lump sum investing works, why don't you just advocate that? And I'm not saying we don't advocate it, but you've got to have the right mindset in order to take advantage of the fact that lump sum investing actually works. Yeah. And if you're worried about your behavior, then simply apply the 401k logic of, it's automatic, set it and forget it. I can't have the money for 20 years. And in that case, you've got to win that investing battle, not in the spreadsheet, but in the chair.
Yeah, I really like that. And I think, we do advocate for lump sum investing, I would say frequently. I don't want to give a percentage on it, but because we know the data. But we also know staying invested is more important than whatever the data says.
Right.
And if that's going to help with the dollar cost averaging.
Right. Because It's not about the strategy that gives you the highest expected rate of return. It's about the strategy that gives you the highest probability of sticking with it.
Correct.
That's the key.
Yeah. And I think when we talk about DCA plans or DCA strategies here at Monument, again, we'll set that time frame, we'll set those amounts. But a big thing that not a lot of other people consider is we have triggers where if the market sells off and gives a buying opportunity, we're going to speed up that plan. And that's in front. We set that up right away. And I think that's always where kind of people miss out on the ability is, sell-offs happen all the time. A 15% decline happens every other year. Meaning, if you're dollar cost averaging and a 15% decline happens, you have a once every other year buying opportunity. Let's take advantage of that.
Right.
Let's put all your money in. Let's capture some of the volatility. So when that market does recover, you're fully invested.
Yeah.
So I think that's a big thing about when people think about dollar cost averaging, they don't have that trigger of at some point, it makes a lot of sense to put more money to work more quickly.
Right.
So I think when you think about everything in totality, that's where you really get these plans going in, because there's always going to be a market event. There's always going to be something that makes you say, I'm terrified. I need to get out of the market. I need to stop the bleeding, whatever it is.
Right. And it's interesting because every time there's some market volatility, like now or a year ago or 2022 or anything like that, one of the popular things that I hear people ask me is, geez, you must be spending a lot of time on the phone with clients and talking to clients and everything. And the reality of it is, it depends, right? So clients who have been clients here for 2 decades have realized the 2 decades of disciplined investing returns in their portfolio. And so when there is a pullback, it doesn't hurt as much because they've got all of that growth in their portfolio. Versus if you get somebody who just became a client in January and the first thing they experience is a 10% pullback, and they're evaluating the advice that they get based on 3 months.
Correct.
Right. So you are talking to those people more because you're trying to tell them, like, look, one day you're going to get to the same place that our clients that have been here for 20 years have gotten to, which is like, this is just another pullback, and it's, I get it. Things go up and down. So a lot of this is just perspective of like, how much time do you have in the market with the person that's giving you advice?
Yeah. And even if you're doing it yourself, again, same thing. It's how much time you have in the market. If this is your first time ever being an investor, and again, you got that $1 million payout, $1 million ready to go,
right.
3 million, even probably more so.
Yeah.
You don't have all that experience. So do these kind of strategies help clients, anyone that are early on in their investing career? Again, I'm going to say no, because you got a long time horizon. You should just do your lump sum investing and make more. Because again, like you said, this 70% of the time you're going to come out ahead, but you're also going to come out significantly ahead.
Right.
Just to use an example, let's say at quarter end, so 3/31/2026, go back 20 years. So this is a time horizon thing as well. If you invested $240,000 up front right away, you'd get about an annualized return of about 10.4% in a portfolio made up of, the S&P 500, just to keep it simple. Now, let's say you did this on a dollar cost averaging where you did $1,000 per month.
Okay.
So the same money you invested, $240,000, you either did it all up front, you got 10.4 annualized. If you do that dollar cost averaging of $1,000 per month, you only up 7.4 per year. So you're annualized
3 percentage point drag.
Yeah, you basically boosted or detracted from your returns by 3% annualized. So every year, roughly, again, compounding also really helps in those situations. Having that lower annualized return, there's significant cost if you have a long-term time horizon. But now we get into the emotional part. If you put that $240,000 in 2006, within 2 years, you're going through the great financial crisis, the world's on fire, and you sold out at the bottom, who cares?
Right.
It's about, I think that's a huge thing for investors, is they're so focused on maximizing returns. It's not about that. It's about creating a plan that's going to give you optimal returns for that long-term strategy, not maximum, right? Optimal meaning it's a strategy you'll stick to. Big difference there, in my opinion.
Yeah, I'll share a memory that I have, and it's a little bit of a case study. There's only one person in the world who will know what I'm talking about right now. he listens to the podcast, he'll know I'm talking about this story. No one else will know who I'm talking about. But this was back in the early portion of the recovery coming out of the 2008 crisis. And I don't remember the exact year, but let's just call it 2010, 11, 12, that sort of time frame. There was a transaction where a company was sold, cash was created, and there was the conversation about when's the right time to get invested.
Mm-hmm.
And there was a lot of what ifs, how about this is, strategizing going on. And I remember the question that I was asked was, is today the day to put the money to work? Because the market had sold off a decent amount.
Yeah.
And my response was, I don't know if today is the best day. I don't know if today is the bottom, but all I know is that 5 years from now, you'll look at it and say, that was the right time to get invested.
Yep.
And that's just a quick vignette about, it's not about finding the absolute bottom of the market, which is really hard to do when the market's down 20%, because when the market's down 20%, that loss aversion kicks in and you think, hey, the losses hurt twice as bad as the gains. And you start thinking, well, if it's down 20%, what's to keep it from going down 30 or 40 or 50 or to zero?
Yeah.
So that's a real behavioral, emotional struggle. But if you're able to forecast out, like you said, time in the market, you may not hit the exact bottom with a lump sum investing. You may not hit the exact greatest timing of dollar cost averaging into the market. But if you let it go for a decent amount of time, the decision in hindsight will probably always be the right one.
Yeah. I mean, it gets back to when you do a dollar cost averaging plan, which again, plenty of people do. You do it in your 401k.
Mm-hmm.
Make sure you have that kicker of, hey, if the markets reach these, I don't want to call them generational buying opportunities, but like a good buying opportunity for the long term, don't be afraid to speed up that cycle.
Yeah, right.
I think that's a big feature of what a good dollar cost averaging plan has is, hey, if the markets are down 15%, down 20%, and I still have cash to be invested, that cash I don't need for 5 years, 10 years, 20 years, put it in the market.
Mm-hmm.
So I think it's not market timing, because up front of that plan of the dollar cost averaging, you set that rule.
Mm-hmm.
So it's not like all of a sudden you're feeling it, but it also helps those decision points be easier.
Yeah.
Because then you don't have to worry about, well, what if the market goes down 10? Well, no, I said I was going to invest it here and it's for this time period.
Yeah.
So, and I think that's just one of the I think we're touching a little bit on why it's so important to stay invested. Because there's a lot of studies out there about missing the 10 best market days has a significant impact on your long-term returns. And normally, when you look at some of the data there, as I pull it up here, but a lot of those days, those really big positive days, they happen around big declines.
Right.
Like frequently. And I think when you look at it, if you go back over 25 years, missing the 10 best market days in the S&P 500, your return is 5.7% annualized. Well, the market overall is about 9.2. So think about that. Your returns are almost cut in half just by missing the 10 best market days of a 25-year period.
Right.
A 25-year period. And because you made an emotional decision and missed 10 of those days, your returns are cut in half. And if you miss the 20 best days, now your returns are 3.4.
Right.
Basically a third of what they could be. And I think so many people are, worried about, I need to miss those big bad days. No. It's actually more important to not miss the good ones.
Exactly. And the chances are, if you behaviorally react to down markets, if you're out of the market on the worst days, the chances are you're not in the market for the best days. That's another way to say it. So you've got to be able to stick with it. One of the things that really impacts people's behavioral reaction to the market is they tend to conflate politics with market returns.
Yeah.
And in an earlier podcast from a month or so ago, we talked about how politics can kind of get in people's way. And I went back and did some data. I'm going to resurface it now for this podcast, but I'm going to go backwards in administrations.
Sure.
In the interest of getting to some of the older administrations, I'm going to skip over the Biden administration. But everybody will remember the Biden administration. It had COVID and it had 2022 in it, so there were some events in there too. But the the Trump 2025, the market dropped nearly 19% during that tariff tantrum, tariff trade-off, tariff sell-off, whatever you want to call it, basically a year ago from today. And the investors who panicked there, they locked in their losses. Meanwhile, the S&P 500 finished 2025 up 18%, right? So there's if you couldn't deal with the downside, or you let political beliefs get in the way of your investing strategy, you miss the best days of the market, most likely, right? Go back to the Trump election night of 2016, which I think is significant because most people weren't projecting that outcome to happen.
Market hates surprises.
Right. So the futures overnight after the election, after he was declared the winner, the futures dropped pre-market by 5%, which set off all of those circuit breakers, right?
Like we talked about, yep.
Yeah, and for people who haven't heard that episode, the circuit breakers are basically exactly what they sound like. If there's a surge of electricity or activity, the circuit breaker pops and says no more. Like, we're just going to suspend trading, essentially is what happened. So it hit limit lockdown, it hit the circuit breakers. But by the end of that day, all right, so the market opened up with the circuit breakers on, and by the end of that day, the market closed up on the day. So it went from, 9:30 circuit breakers were in to 4 o'clock, market is up. And the S&P 500 returned 21% in 2017. So again, there's just another example. I'm going to go back to Obama 2009. He took office with the economy in basically a free fall. That was 2028. And yes, the market was sliding towards its ultimate March bottom in 2009, but the predictions that were on the news about his policies were that his policies would thrust us even further into a recession and cause even more damage. Okay, surprise, the S&P 500 gained 72% in his first term, so 4 years, first term, right, 72%, and then 71% in his second term. I'm pretty close on those. I mean, so roughly, some Dave Armstrong rounding up and fluffing the numbers up a little bit, 200%.
Yeah.
So, you just can't let your political beliefs go in there. You had the Clinton impeachment in 1998. You would think that very significant impeachment vote. The S&P 500 finished up 1998 by 30%, essentially. And then Reagan, Iran-Contra. I mean, that was the largest presidential approval drop ever recorded in a single month, ever. Yet and his approval rating went down like 20-some%.
Wow.
I know, in a single month. Okay, he had Oliver North up there with his alpha uniforms on, testifying in front of Congress, that iconic picture. And anyway, the S&P 500 finished up 19% that year.
Yeah.
So these are these things where you start to feel like I can't take it anymore. And if you get out of the market and you're not there for the strongest rebound days, these are all great examples of where emotion can come in and political beliefs can come in to the detriment of your own financial health and well-being.
Well, and it also prevents people from deploying cash when they should.
Yeah, exactly.
So that's the other piece of this is if you're invested already pre-invest, keep your stuff invested. But if you have cash to invest, volatility is an opportunity. Now, I think we said this, you're never going to pick the exact bottom.
Right.
So even if, let's say, markets are down like in 2008 with that great financial crisis, you could have invested when the markets were down 15%. You would have had to experience more losses.
Yeah.
But think about all that gain that you talked about during the Obama administration after the bottom in 2009. You got all that gain.
Yep.
So just volatility is a dirty word, but if you have cash to put to work, it's not a bad thing. But you just got to be able to, again, still remove your emotion. Just like if you are invested, stay invested through volatility. Have a plan for how to capture volatility if you're deploying cash.
Yeah.
So that's where it gets into, again, lump sum investing, dollar cost averaging. But once you're in the market, it's about staying invested. And I think the other piece of it that a lot of people, when they think about how do I stay invested?
Yeah.
What does that mean? Well, it means setting up your time horizon. Now, I think intuitively, and being in the industry, you and I know what time horizon is. But for a lot of people, they go, well, I don't know. Like, what is my time horizon? Is it until I'm buying a house in 2 years? Is that my time horizon? I'm retiring in 10 years. Is that my time horizon? Or is the time horizon until the day I die?
Yeah.
And the answer is all of them.
It is. and it can be very, for people who are listening, it can be very easily answered by just asking yourself and answering the question, what's the money for? Because it could be for a bunch of different things, right? Could be that, what's the money for? I'm buying a new house and I need a down payment. Okay, that's a short time horizon.
Yeah.
If you're right, because you need cash to put a down payment on a house. But your time horizon could also be, and I'm saving for and investing for retirement. Separate time horizons. So you can have multiple time horizons that have to be accounted for inside of a solid investment strategy.
Correct. And they're invested very differently.
Right.
The shorter your time horizon, the less risk you can take on. So for bigger goals that are in the short term, you take even less risk. But even still, you got to stick to that strategy. Even if you're being a bond investor or sitting in cash, having a way to earn some interest on that cash. That's a short-term investment strategy for a short-term time horizon, but you got to stick to it.
Right.
Versus, again, the longer-term time horizons are actually harder to stick to because usually you're having more volatility in the assets. But the more volatility usually leads to more growth.
Right.
So that's the trade-offs all the time is people go, well, my time horizon is, until I die. It's like, okay, so you're not doing anything from today until the day you die? What's the money for? What do you need? When do you need it?
Right.
And that's how you can build a strategy, I think, or strategies that make up your whole portfolio.
Yeah.
And whether you're using dollar cost averaging, whether you're using, a bond ladder portfolio where you're just kind of, clipping your coupons and holding on to it because you have a short-term need, or you're doing 401k investing. Again, dollar cost averaging helps a lot because you're forced there, but it helps you stay the course.
Right.
And that's what it is. It's about staying the course of your time horizon, regardless of what the strategy is underneath.
It also is important too because this is where we talk about having the 12 to 18 months of cash. So you can have multiple time horizons, multiple answers to what's the money for. My experience has been that it is rarely a surprise that a big expense comes up overnight.
Yes.
It's a surprise when people call us up and say they need the money, right? That's the surprise. But rarely do people wake up and say, I slept on it last night and I've decided I'm going to buy a house today. I'm going to buy a new car today. I'm going to renovate the kitchen today. I am going to take a very expensive vacation to Italy for 3 weeks. Those are things that people think about for a long, long time. So it's more about, hey, if you can identify these needs for cash in the short term and just raise them like now when the market is pretty close to an all-time high, you're going to spend the money anyway. So maybe you're giving up a little bit more upside, but the trade-off there is you are eliminating the possibility that your dollar is worth 75 cents when you actually do go on that vacation or actually do decide to renovate the kitchen or need that short-term cash. So to the extent possible that you can answer that question, what's the money for, and identify the short-term needs and raise that cash, create that cash when the markets are close to an all-time high or at least up.
Yeah.
That is a good market timing decision.
Correct. Yes. And again, it's one you got to be comfortable with. Is it the perfect one? No, because to your point, markets can skyrocket higher.
Right. Or skyrocket lower.
In either way.
Skyrocket doesn't really scale, but right.
Plummet. I like that one. I always, whenever I hear the word plummet on CNBC, I'm like, oh, they're really selling me hard today. But it's really the focus on cash is an asset. We believe cash is an asset in your portfolio. So whether you're deploying it or in this case, planning for it, you got to make sure you're being intentional, strategic with your cash position. So again, you could just invest it all lump sum, but has its risk. People do that dollar cost averaging, but then raising cash and having the cash that you need is again, that behavioral thing that we're talking about.
Right.
Really the conversation is more about what are some strategies to help manage investor behavior. I know we're talking about dollar cost averaging, or we said we were at the top, but really at the end of the day, being a good investor means managing your emotions. And there's ways that you can do that very simply. Have a plan, whether it's, again, how to put money into the market or how to take it out.
Yeah.
That's really what it comes down to. And that adds a lot of value over time because that lets the longer term time horizon money grow, and you don't got to worry about it.
Right.
In a weird way, that's another way your 401k is great because as you said up front, people look at it, maybe like twice a year, maybe once a year, if that. And they usually do it, unfortunately, when the markets are selling off because they're like, oh my God, what's happening to my money? They rarely like to look at it and be like, oh, markets are doing well. I wonder how I'm doing. It's always, oh my God, it's the fear that always comes out.
And another thing people could do too is just be aware of some of the statistics. And there's this thing called the Dalbar study, and it's been out, it's 30 years old. And one of the things it does now, it's not rife with assumptions, but there's some
Sure.
there are some asterisks in there, but the overall point is still powerful enough to look at it and say, okay, this is probably. And what the Dalbar study says is that it goes in and it looks at all of this data on funds and ETFs that people hold. And I'm just making this example up, but what it does is it'll say like, okay, we're going to look to see what fund Dave was in on January 1st in his statement. And then at the end of the year, we're going to look at what his account performance was based on holding that. I'm just going to make an example.
Yeah.
The S&P 500 SPY ETF, I own it on January 1st.
And you held it all year?
Well, maybe.
Okay.
They know that I owned it on January 1st. And then on December 31st, they'll go say, how well did Dave's account perform this calendar year? And then how well did the actual SPY perform over the calendar year? And what they find is that the individual return of the individual is not as good as the return because people get in there and they sell so people are actually individual investors are underperforming the funds that they actually invest in because they're in there tinkering with it and messing with it.
Yeah.
And that's just an interesting thing. So, you got same fund, same time period, worse result. The only variable in there is behavior. Okay. So I think this gets to the value of advice, and everybody is capable of going out and researching the internet and finding out what a good portfolio should look like. But it's the behavioral aspect of it, and the Dalbar study says that people are really bad about sticking with their plans. So some of the value of getting advice, I will use the example of going and working out in the gym. Okay. So at my age, one of the worst things that could happen to me is I could get hurt going to the gym. Now, could I get on the internet and get a workout plan for somebody my age that's, good enough to go and take that piece of paper and go into Planet Fitness and start, jack and steel and, trying to do my own thing, right? Okay, sure, I could. What are the variables in there? Discipline. Do I go? Do I blow it off?
Do you stick to the plan?
Discipline, like, am I looking around and, I'm like, oh, that guy's lifting more than me. Maybe I ought to throw a couple more 25s on the bench press, and the next thing you know, I'm getting hurt, something like that, or any other exercise. So am I totally capable of DIY? Yeah. Is it likely that I get hurt or miss a workout or become inconsistent or do something stupid in the gym? Like, I don't know, try to impress somebody that's lifting next to me, whatever, or, God forbid people are setting up their selfie sticks in there and recording, or I end up on some Instagram site where, somebody drops the dumbbell on their foot, and, all of a sudden you're saying, okay. Or do I go see my personal trainer who could be executing the same workout strategy, maybe something better, but it's fine-tuned to me. I have accountability because I have to be there at a certain time. The person's making sure that I'm not getting hurt. And if I did do something like hurt my elbow or hold my shoulder, like they scale it back and they make sure that I'm not compounding the injury. So there's a value for hiring a personal trainer. I think it's the same logic with this too, which is, hey, I'm sure there's a huge component, maybe not a huge component. There's a component of people listening to this that are they're completely disciplined about going to the, and eating meal prepping and doing all that stuff. And then there's people like me who are the minute I don't have to be there at 5 o'clock for my workout, I'm probably going to find an excuse to be like, oh, I'll go in a few minutes. And the next thing you know, it's 7 o'clock and I'm tired and I don't want to go.
Exactly.
Right. Or I end up with a barbell on my foot.
Yeah. Well, God forbid. I was in a walking boot earlier this year. But the broader point there is, I think when we talk about these kind of strategies, the dollar cost averaging ones, and how to be an investor in volatile markets, it's more behavioral than science. Because I can tell you what science says. Because to use your analogy, that workout plan, they're pulling from scientific stuff online. If you use a chatbot, I'm sure it's looking up what is an optimal workout for your age, for your goals. But that doesn't help you stick to it. You got to have the will and drive to stick to it. And that comes from you as an investor, as a person. If you can do that, there's ways, again, you can do all your research and you can learn and see that, hey, I know if I just invested all my money up front, it's going to be more volatile. I might, it might be tougher on my psyche, but I'm going to make more money. And there's other people out there, to your point, that need the plan, the structure, and someone to help them through that. Because a lot of people, when they get to the moment, let's say, of I have my dollar cost averaging plan, if the market goes down 15%, I'm putting it all in.
Right.
Well, if the market's hit 15%, are you going to stick to your plan? Or are you going to be, I'll get to the gym in a few minutes. I'll get to that maybe if it goes down another 5. Well, that's where you can have kind of an investing therapist who will say, hey, this was the plan up front. We hit this mark. I really think we should stick to our plan. Here's why.
Right.
That's what you really need to be doing. Whether you do that yourself internally or you have someone help you with it, that's what makes a successful dollar cost averaging strategy, is sticking to the plan and investing for that time horizon and setting the investment strategy for your time horizon.
Yeah.
Because you can do that with any kind of portfolio. Again, to use the workout analogy, if I wanted to improve arm strength, okay, well, you do these workouts. Well, I actually need to get better at running. I want to have more cardio. Okay, you get there.
Mm-hmm.
Different strategies for different goals. Maybe one, I want to be a power lifter. One, I want to run a marathon. I don't want to do either. Honestly, they both sound like they suck. I've seen people run marathons. It's awful.
Yeah.
But some people like that. So just have that strategy. And when it gets to be tough and you want to quit, the markets are down 20%.
Yeah.
That's not a bad thing. It's normal. It's going to happen. Plan for it when the markets aren't down from day one. So I know we say that a lot, but to your point, there's a lot of studies out there like that Dalbar study or the Mind the Gap study that Morningstar does every year. Same concepts.
Yeah.
They show exactly what emotions and not sticking to your strategy has the impact on your portfolio.
Right. Because we're wired as humans, our brains are wired to do the exact wrong thing. So our instincts, that when you talk about, I have a gut feeling, that's really great when you're a caveman walking through the woods and the lion jumps out of the bushes and you have to save your life by, relying on your instincts and your reaction time. Or you're the caveman hiking down the path and you're like, oh, that's where the lions hang out. I've got a bad feeling about, I better shift directions. Your brain is perfectly wired for survival instincts.
Yeah.
The problem is investing is not a survival instinct, but it evokes those behavioral traits. And when you say, I've got a bad feeling about insert whatever it is, this administration, this inflation report, this economy, the direction of earnings, the bad news here, the war over there, the Houthis shooting missiles here, this going on, that going on, are we invading Greenland? Does Canada hate us? All of these things that can give you these bad feelings, you are wired to react to those things when you shouldn't be.
Yeah.
And that's where the value of advice can come in and be beneficial to somebody.
Yeah. And have someone to hold you accountable. Right. Because the more I think about it, we have plenty of people out there who, again, get those gut feelings about one way or another of if they're fully invested, well, I think we need to get out. Okay. Or the more painful one for me is someone who has all this wealth, that $1 million, that $3 million of cash that they need to get deployed. And kind of just to wrap up on your anecdote again, like back in 2008, you may not be hitting the perfect day to invest, but given that you have 5 or more years, you're going to be very happy that you took advantage of this kind of environment.
Right.
So, I mean, again, it's have a plan, stick to it, but make sure your plan is also a little maybe flexible because things are going to change along the way. So have the plan with flexibility built in, like I keep talking about with these triggers of, I said I'm going to invest $250,000 for the next 8 quarters or the next 4 quarters. But man, if I get an opportunity, let's go hunt. If I see something out there, there's ways that you can help yourself in the long term better align with the data. Because it still says be a lump sum investor, plan for your time horizon. That's how you're going to get the maximum result if you can stick to it.
Right. Exactly. So great conversation on this topic. The conversation of how to do the strategy, how to look at it. There's not really one thing that, you could pick lump sum investing, you could pick dollar cost averaging. It depends on how in control you are of your behavior, the value of advice and sticking to the plan and being accountable and things like that. All of those things together are the components of a good investment strategy. Really can't just hold one out on its own. And I will just reiterate this one more time. People who feel like they can trust their gut on investing are relying on the wrong survival instincts, right? if, again, if you're going to get attacked by a mountain lion out hiking in California, that's one thing, but your gut feeling about what's going to happen tomorrow or the next day, hey, is Ebola virus going to come wipe us all out? Like, you just don't know. And your gut is not a really good gauge for a solid investing strategy.
No. Well, that wraps up Off the Wall, but also financial therapy, right?
Exactly,
Like, there's your financial therapist for the day.
Right.
You get to sit down and listen to Dave and Nate. So, well, that kind of wraps up another episode of Off the Wall and your financial therapy for the day.
Yeah.
So you're welcome, everyone. We'll send you our hourly bill for all the listeners. And we always like to remind everyone, we do monthly AMA's mailbag episodes. So answering questions people have, leave a comment, send us an email at offthewall, all one word, at monumentwm.com. We always get great questions, and that way we can keep Dave and I without going down too many rabbit holes.
Right. Or if you see us posting on LinkedIn or sharing the episode or anything like that, if you leave a comment in LinkedIn or Instagram or anything like that with a question that you have, that's another great medium for getting us your questions. But we appreciate it because it feeds into our Ask Monument Anything future episodes. So keep the questions coming.
The content presented by Monument Capital Management LLC is intended for general informational and educational purposes only. No portion of this content should be construed as the receipt of or a substitute for personalized investment, financial, legal, or tax advice. Monument is neither a law firm nor an accounting firm, and no content should be interpreted as legal or accounting advice. Any discussions of investment strategies, financial planning concepts, or related topics are general in nature and may not be appropriate for every individual or situation. Different types of investments involve varying degrees of risk, and there can be no assurance that any investment strategy, planning approach, or discussion referenced will be profitable, suitable, or successful for any particular person or circumstance. Past performance is not indicative of future results. From time to time, this content may reference hypothetical situations, illustrative examples, or stories that do not involve actual Monument clients. These scenarios are designed solely to illustrate concepts or demonstrate how Monument might approach similar situations and should not be interpreted as endorsements, testimonials, or guarantees of any particular outcome. No two clients, situations, or experiences are exactly alike, and results will vary. Nothing discussed should be interpreted as a guarantee that any client or prospective client will experience a specific level of results or satisfaction if Monument is engaged or continues to be engaged to provide investment advisory services. Monument's investment advisor registration status or any prior experience should not be construed as an assurance of future performance or success. Copies of Monument's current Form ADV Part 2A, disclosure brochure, and Form CRS, which discuss our advisory services and fees, are available upon request or at www.monumentwealthmanagement.com/disclosures.